Hello and welcome to the Weekly Market Metrics. I'm your host Sandeep and we are in week 51 of the year, just one more week to go in 2025. Every year in December, people talk about a phenomena called Santa Rally or Christmas Rally in the indexes. What that means is the last week of the year has higher odds of a positive move. Now, obviously, I'm not sure if it'll happen again this year. But me being me, I looked up some data for the past 10 years. So what I tested for is we go long on the 5th last trading day of December and exit on the 2nd trading day of January. Here's what the data tells us. There is a 70% chance of the month closing in positive. Median returns are at 1.21%. All the past 7 years have been positive. For the current year, 5th day from the end of the year will be 26th December, Friday, and the exit date will be on the 2nd of Jan. Let's see how it plays out. But in reality, this end of the month positive drift is not something specific only to December. It works for most months across the world. It's called TOTM, Turn of the Month Anomaly. Maybe I'll do a video on it sometime. Talking about the weak markets continue to test our patience and also at times scared us a fair bit by making a low of close to 25,700 only to bounce back in the last session, a bit similar to what we saw last week. This week again, we are at the same spot. We saw a down move in the first 4 days with some recovery in the last session. So what to expect now? Let's check the charts and see how the price action has played out and what looks possible for the coming week. As always, Nifty first. On the weekly time frame, after 3 strong green weekly candles, Nifty has now printed 3 consecutive red candles. The latest week formed a bearish inside candle with the entire range contained within the previous week's candle, signaling consolidation and indecision. Nifty actually slipped about 80 points or 0.31%, closing near 25,966, just below the 26,000 levels. The weekly range narrowed sharply to 320 points, which is 1.23%, down from last week's 485 points. Support continues to hold at the 25,850, 25,700 zone, a level Nifty has defended for the past 2 weeks. On the upside, immediate resistance lies at 26,200, followed by the all-time high near 26,325. As long as Nifty remains between 25,700 and 26,200, the structure stays range-bound. As of now, the bias remains sideways unless we see a weekly close above 26,200 or if we see weakness below 25,700. On the daily time frame, the same consolidation pattern continues, with Nifty showing weakness in the early part of the week followed by a mild recovery towards the end. This week, Nifty printed 4 consecutive red candles, extending the pattern we've been seeing over the past 2 weeks, with Friday finally closing in the green. Once again, buying emerged near 25,700 level where Nifty managed to stabilize and bounce. Now, despite the bounce, there is still no clear bullish strength visible on the daily chart. Nifty continues to remain stuck in a broad 500-point range between 25,700 and 26,200, with 26,000 and 26,100 acting as immediate resistance zones. As we discussed last week, this move continues to look like a month-long consolidation rather than a fresh uptrend. Now, until Nifty manages a strong daily close above 26,150 or 26,200 zone, the broader bias remains sideways. For now, 25,700 remains the key support to watch, while 26,200 continues to cap the upside, keeping the index range-bound in the near term. Now, moving on to Nifty on an hourly time frame, it stayed briefly above the 50 EMA on Monday, but from Tuesday through Thursday, it traded consistently below the 50 EMA before trying to move back up on Friday. Now, this back and forth around the 50 EMA clearly shows the absence of any clean short-term trend. This is exactly why trend following has been extremely difficult in Nifty over the past few weeks. Even though December is historically an uptrending month, this December has turned out to be very tough, especially for directional traders. In such an environment, positional non-directional sellers are the ones benefiting, while trend followers continue to get whipsawed with limited follow-through on either side. At the moment, Nifty is above the 50 MA by just 50 points on the hourly chart, and unless we see a sustained price action above it, the market is likely to remain choppy. Overall, based on the 1 hour time frame, the bias remains sideways with no clear edge for trend-based trades. Now, talking about Nifty's expected range till expiry on Tuesday, that is 23rd December, if we look at the options data, the at-the-money straddle closed around 155 points, which is broadly in line with last week. With Nifty spot closing near 25,966, this gives us an expected expiry range of 25,966 plus 155, which is 26,121 on the upside, and 25,966 minus 155, which is 25,811 on the downside. So effectively, the market is pricing in a roughly 300-point range with 26,100 on the upside and 25,800 on the downside as the key levels to watch into expiry. Now, if you look at the open interest data, 26,000 CE and 25,900 PE currently hold the highest open contracts. This suggests that 26,000 is emerging as a strong resistance zone. When we combine this with our weekly and daily chart analysis, where 26,000, 26,100 and 26,200 have already been identified as resistance levels, it becomes clear that the upside for Nifty is likely to face multiple hurdles. So my guess is, even if Nifty attempts a move higher, the journey upward may not be smooth, as selling pressure is likely to emerge at multiple levels. For now, this further reinforces the view of a sideways range-bound market, especially as we approach expiry. Moving on to SENSEX on a weekly time frame, SENSEX also made a bearish inside candle. It closed 338 points or 0.4% lower, settling near 84,930. This marks the second consecutive red week, coming after a strong run of 4 green weekly candles. The weekly range narrowed to about 1,040 points, that is 1.22%, compared to last week's much wider 1,500 plus point range, indicating ongoing consolidation. On the downside, supports are at 84,500 and then near 84,200. On the upside, resistance is seen near 85,300, followed by 85,700. For now, SENSEX appears to be consolidating within a broad range with no clear directional edge on the weekly chart. On the daily time frame, SENSEX mirrors the Nifty structure: 4 consecutive red candles followed by a green candle on Friday. SENSEX is currently range-bound with 84,400 acting as key support and 85,300 as immediate resistance on the daily chart. A higher resistance zone is placed near 85,700. Overall, the bias for SENSEX remains sideways until a decisive breakout or a breakdown from this range happens. Talking about the expected range for SENSEX till the coming expiry, the SENSEX at the mini straddle closed at 636 points, down from 719 points last week. Based on this, upside resistance would be at 85,565, that is 84,929 plus 636, and on the downside, support would be at 84,293, which is 84,926 minus 636. This implies an expected move of approximately 0.75% or 600 points on either side. Also, do note that SENSEX expiry is on Wednesday next week due to the trading holiday on Thursday. This makes the current SENSEX ATM straddle a 3DT at closing premium. Moving on to BANKNIFTY on a daily time frame, BANKNIFTY closed in green on Monday, followed by 3 consecutive red candles. Friday's candle was indecisive, which closely resembled last Friday's candle. BANKNIFTY closed at 59,069 for the week and lost about 321 points or 0.54%. It formed a weekly range of 820 points, which is 1.38%, slightly lower than last week's 913-point range. Also during the week, BANKNIFTY bounced from the 58,700 level, which continues to act as a strong support zone over the past several weeks. Resistance remains intact near the 59,550 zone. Overall, the trend remains sideways, with BANKNIFTY trapped between 59,550 and 58,700, a range of approximately 850 points. On the hourly time frame, BANKNIFTY remained choppy on Monday and then spent most of the week trading below the 50 EMA with multiple pullbacks that faced rejection near the EMA. This price action suggests a sideways and choppy market with no clear short-term trend in place. Now, needless to say, short-term trend following setups continue to struggle in such an environment. Moving on to ROC or rate of change, it was another flat to negative week across indexes with week-to-date returns around minus 0.5%. This can clearly be classified as a consolidation week. With just 1.5 weeks left in 2025 and all major indexes trading within 1 to 1.5% of their all-time highs, the 1+ month of consolidation is getting too frustrating. High time we get some direction in a steady trend. Looking at the top 5 sectors this week, PSU Bank tops the list after a 2-week break followed by NIFTY IT. Perhaps because of the weak rupee, it's back in top 5 after a week's pause. And next we have FMCG show up in the list after a good 9 weeks. My observation is that FMCG shows up only when the markets seek some sort of defensive sectors. Perhaps it was one of those weeks. Then we have Nifty Infra and Metal, which continue from the past week. That's about it in the sectors. Talking about range and expiries, this week again, Friday continued to be the lowest daily range day for all 4 indexes, as seen in the daily range column. Thursday was the highest range day for all 4 indices. Now, it's worth noting that Nifty's 5-day average range has shrunk to 147 from 208 last week, confirming a consolidation week. And the 10-day average range also shrank from 195 to 178. Now let's talk about Nifty's expiry this week. Now this week, Nifty's expiry saw a range of 146 points, while the opening ATM straddle premium was at 108 points. The index saw a 167 points or 0.4% down move on that day. Overall, it was a relatively easy expiry, especially for far OTM sellers. I'd rate this expiry 3 out of 10 on an easy to hard scale. SENSEX expiry on Thursday was far from easy. The index dropped 330 points in the first 30 minutes, then rallied 541 points till 1 p.m. and later sold off 409 points to finally close 78 points lower than the previous day. The day managed to do a 542 point range against the ATM straddle premium of 316 points at open. I would rate this expiry 6 out of 10 for sellers, where 1 is easy and 10 is hard. Talking about India VIX, it fell 5.8% this week, closing below 10. Such low VIX levels indicate compressed option premiums, making the risk-reward unfavorable for option sellers. Like any price, VIX is mean reverting. So from these levels, the probability of VIX rising in the coming weeks is higher than it falling further. Let's see how it plays out. Moving on to commodities this week, the price action in the commodity pack this week is very similar to last week's in terms of general direction, only a little muted. Silver continued to lead and was up 6.5%, and it's at about 113% YTD. And then we had copper, which was up 1.5%, and then gold at 0.1%. Crude was down 3.4% and natural gas about 6.5%. In total, about 17% down for the month. In hindsight, one could have gone long on silver and short on nat gas and could have retired. Okay, I'm just kidding on this one. So that's pretty much in the commodities this week. In summary, the markets consolidated again this week and the last trading day has raised our hopes again. On commodities, it was a good week for silver if you were long and natural gas if you were short. It's generally been a 6-7-ish week for option sellers. Yes, I just learned that slang from some of my Gen Z colleagues. Okay, in all seriousness, hoping for better price action in the coming weeks. Let's see. Beyond the markets and the numbers, moving on to what caught my attention this week. One, I read this memo from Howard Marks on the AI bubble. Well-structured thought process as one would expect from him. His conclusion is that while AI is likely a unique genie out of the bottle technology that may replace human cognition, current market behavior is undeniably speculative. With almost everyone calling out the bubble, it's really getting interesting. Next, I came across this USD INR exchange rate data from 1947 and I thought, why not plot it and see how it looks like. As evident since independence, that is over 78 years, the rupee in general has been decreasing in value with respect to the US dollar. Now, whether that's a good or a bad thing is for the economists among us to argue. I'm just looking at the data. And if you notice, there is a period between 2002 and 2007, the only period when rupee strengthened. Perhaps because of the massive FDI, FPI flows and increasing forex reserves during this time. This was also a golden period for the Indian IT services. Post that, we've never seen a single year like that. I'll share the link with the data in the show notes. If you want, you could play with it. Lastly, I was reading about the current status of the US-India trade deal. Seems it may continue to be in a limbo for a while. What the article says is there is a fair bit of pressure to open up agriculture for genetically modified crops and buy US oil products such as aviation fuel and ethanol. This CNBC article is a good read if you are interested to understand what's happening on the trade deal front. I'll share the link in the show notes. Now over to what to expect in the coming week. Next week is the 4th week of December and we've got just 4 trading days, with 25th, which is a Thursday, being off for Christmas. So SENSEX monthly expiry moves from 25th Thursday to 24th Wednesday. NIFTY has one more weekly expiry on 23rd Tuesday before its monthly expiry on 30th Tuesday. There are no other scheduled economic events for the week. With the positive price action on Friday, my hopes are up again for a Santa rally. Let's see. But this year in general hasn't been the best, so I will keep my expectations in check. On that sobering note, we come to the end of this week's Market Metrics episode. And yes, don't forget to subscribe to the channel. Until then, stay curious, stay steady, and have a great weekend.